Most people believe one simple rule protects their credit score. Pay your credit card on time. But here's something strange. Every year, millions of people lose 30 to 50 points on their credit score, even though they never missed a payment. No late bills, no new debt, nothing irresponsible. The drop usually happens because of one tiny timing rule inside the credit system that banks rarely explain. And once you understand how credit scores actually read behavior, you start noticing patterns that feel almost like loopholes hiding inside the system. Not illegal tricks, not hacks, just rules most people were never taught. And one of those rules quietly affects millions of credit scores every single month. My name is Oliver, and I spend a lot of time studying how financial systems actually work behind the scenes, especially credit scoring. Because millions of people try to improve their credit score, yet the number often feels random. You pay your bills, you avoid debt, you try to do everything right, and somehow the score still moves in the wrong direction. But here's the key misunderstanding. Credit scores don't really measure money. They measure patterns of behavior. The system isn't asking, did this person pay their bill? It's asking something more predictive. How does this person behave around credit over time? And once you start seeing those patterns, the system suddenly makes a lot more sense. Let's start with one of the most important rules, because this single detail quietly moves millions of credit scores every month. One of the biggest drivers of a credit score is something called credit utilization. This simply means the percentage of your available credit that you're currently using, and it makes up roughly 30% of a typical FICO score. So naturally, people assume something simple. If you pay your credit card bill every month, your utilization stays low. But here's where things get interesting. The credit system doesn't always look at the balance after you pay your bill. Instead, many credit card companies report the balance when the statement closes, which means the system might record a high balance even if you pay it off just a few days later. And that single reporting moment can dramatically change what the credit system sees. Someone could pay their credit card in full every month and still appear to be using 70 or even 80% of their credit limit. And when utilization spikes that high, a credit score can easily move 20 to 50 points. Prediction moment. To see how powerful timing can be, imagine two people. Both spend $1,000 per month on their credit card. Both pay the balance in full, but they handle the timing differently. Person A waits until the statement arrives, then pays the balance. Person B pays most of the balance before the statement closes. Same spending, same payments. But the credit system sees two completely different signals. Person A may appear to be using a large portion of their credit. Person B appears to be using very little. And that tiny timing difference alone can shift a credit score by dozens of points. The system isn't judging intentions, it's reading patterns. Why the system works this way? At first, this might seem unfair. Why would the system work like that? The answer is actually simple. Credit scoring models were never designed to measure fairness. They were designed to predict risk. Banks want to estimate the probability that someone might default on a loan in the future. And historically, one of the strongest warning signals has been high credit usage. Borrowers who consistently use a large portion of their available credit are statistically more likely to miss payments later. So the system reacts early, sometimes earlier than people expect. Another rule inside the credit system involves something surprisingly simple: time. About 15% of a FICO score comes from the length of your credit history. Older accounts build trust in the system. But many people accidentally damage their score by doing something that seems completely logical: closing their oldest credit card. Maybe the card has an annual fee. Maybe they stopped using it. Maybe they just want fewer accounts to manage. But in the credit system, older accounts act like credibility anchors. Once that account disappears, the average age of your credit history drops. And sometimes that change alone can lower a credit score by 20 points or more. Another signal the system watches closely is credit inquiries. When you apply for a credit card or loan, the lender performs a hard inquiry. Each inquiry can lower a credit score slightly, usually around 3 to 5 points. But multiple inquiries in a short period can signal something the system doesn't like: possible financial stress. However, there's an interesting detail most people never hear about: the CR. The credit system understands that people compare loan offers, so certain inquiries, like mortgages or auto loans, are grouped together, which means several checks within a short window are often treated as a single inquiry. The system is trying to detect risky behavior, not punish normal financial decisions. The momentum effect. This is where credit scores start behaving almost like momentum. At first, improving a score can feel slow. Someone might move from 600 to 620, not very exciting. But something interesting happens once a score moves into higher ranges. Around 700 and above, the financial system starts reacting very differently. Interest rates drop, loan approvals become easier, credit limits increase, and suddenly, the exact same financial behavior produces much better outcomes. Story section. A friend of mine experienced this shift firsthand. For years, his credit score stayed around 610. Loan offers always came with high interest rates. Credit limits stayed low. It felt like the system was working against him. But the change didn't come from one dramatic move. It came from several small adjustments: lower balances, fewer credit applications, longer account history. Over time, his score slowly climbed to 740, and suddenly everything changed. Better loan offers, higher limits, lower interest rates. The system finally started seeing him as predictable. Final lesson. Here's the real takeaway. Credit scores aren't really measuring money, they're measuring behavior patterns, consistency, timing, risk signals. The system is constantly asking one simple question: how predictable is this borrower? And once you understand that idea, the credit system stops feeling mysterious. Callback ending. Remember the question from the beginning? How someone could pay every bill on time and still lose 30 or 40 points on their credit score? Now you know why. It's usually not about the payment itself. It's about the signals the system records along the way. And once you start understanding those signals, the credit system becomes far less confusing and much more predictable.